This week there have been new warnings that there is a housing market slowdown on the way in the next year. This comes on top of previous warnings by banks, but this is now from the Royal Institute of Chartered Surveyors. Now, I'll come on to that. My name is Charles Kelly, Money Tips. I put out these free podcasts every week, so please like and subscribe. And I will also tell you about a special offer that I can help you manage your way and come out thriving through the coming downturn. We're already in the downturn, let's face it, so let's not beat around the bush. Now, this warning comes on top of a warning by previous warnings by banks like HSBC, warning of a housing market slowdown, saying that the number of people struggling with their mortgages is set to increase sharply next year to a 15-year high. Now, this is from the Royal Institute of Chartered Surveyors. This is not from some guy on YouTube. This is from the people that regulate all the surveyors and valuers that value properties on behalf of lenders when they're giving out a mortgage. So do you think they know a thing or two about property and valuations? Yes, of course they do. They know exactly what's happening in the market. They survey all their members and they've come up with some figures. Now, what can you do about all these things and market conditions? But of course, we can't do much about that at all, but we can do something about our own financial situation. Let me give you the details about this new warning. House sales in September, just last month, hit their lowest level since what's been happening in 2020 and 21. Rising mortgage rates will drive the house prices down next year, say the RICS. Now, that's unusual that a body representing estate agents and valuers and the market, actually come out and predict these things. Normally they're very reserved about actually issuing warnings like this. But we've always seen that lenders, I know anecdotally that lenders are telling valuers, look, calm the valuations down. Let's not overvalue properties. Let's be very conservative, because the lenders don't want to get caught with literally with their pants down where they're lending, say, 100%, which they don't really do anymore, but this is what happened in previous financial crises. They overlent. People couldn't afford to pay the mortgage. They were in their negative equity, so the value of their mortgage was higher than their homes. And some people, I think rather unwisely, just sort of handed the keys back to the lenders, and lenders obviously lost money in that case. So they don't want to get caught in that position again. Other things that happened this week is that the Bank of England said that the number of people struggling to pay their mortgages will rise in the next year. That doesn't take much working out. New house buyers inquiry fell in September, the 5th month in a row. This is according to the RICS again. And fewer properties for sale, although that's pushing up house prices. They think that this trend will end. So in other words, there's been a shortage of properties. All the estate agents say, well, there's a shortage of properties. If I had all these properties, I could sell more. But they feel that this trend will end. I'm certainly seeing a lot more price reduction notes coming through from estate agents saying, look, this has just come down in price by 50,000. They're great property. They're really selling. Whereas, a year or so ago, you couldn't get any price reductions. And it was definitely a seller's market, as they say. Banks such as HSBC have issued similar warnings of a housing market slowdown. They're a big lender. They're all nervous. And I feel, this is from me, that higher interest rates will make buy-to-let purchases virtually unsustainable. Now, I'm going to go through this in my property podcast this week, so listen out for that in the next couple of days. I'm going to show you exactly why I think buying a new property for a buy-to-let will become almost unsustainable unless you're putting down a huge deposit or buying for cash. But if you're borrowing money, I think these higher interest rates will just wipe out any thoughts of profits and that sort of thing. So I'll come back to that. Fixed rates will have now are reaching 2% and 5% according to the BBC. Now reaching 6%. These are fixed rate mortgage deals, and that's a 300% rise, and really is a game changer for people, because you're going from people borrowing a lot of money and to buy their homes, and then they've got a 2-5 year fixed rate deal, and then they come to the end of that, and then they've got to then pay 6%, which is a huge jump. It's a huge jump. I mean, if you think if your mortgage is going up by, say, 4% in a year, and you owe £100,000, that's another £4,000 a year. If you owe £200,000, that's £8,000 extra a year. But imagine those people who've got huge mortgages, like £300,000. That's £12,000 a year. That is £1,000 a month extra on their mortgage. Okay, that's not the extra electricity bills and the food prices rising. That's £1,000 extra on their mortgage, assuming that rates will jump from say 2 to 6%. Well, that's what's happening. And the BBC on the news the other day said that up to 200,000 households will need to remortgage or maybe change their deals in the next year. And lenders are not going to lend to people who want to remortgage if rates have suddenly jumped by 300% and their income has stayed the same. Similarly with buy-to-let mortgages, they're not going to lend on unsustainable deals. They're not going to lend on unprofitable deals that just don't wipe their feet to investors. So that's going to kill a lot of the market anyway. And also, just one other thing, just to help the buy-to-let market, Liz Truss said in Parliament the other day, during PM questions, she was asked whether she will push through with the legislation to end no-fault evictions, and she said yes. So thanks a lot, government, for helping the buy-to-let market and helping landlords. Yeah, great news. But I'll be talking more about that in my property podcast. I just want to quickly give you this news today, because this all comes on top of a brewing financial crisis. Don't forget, in the last week or so since the mini budget, a couple of weeks ago, the Bank of England had to step in to buy government bonds. I'm not going to go into the technicalities of that, but bonds are IOUs issued by the government. They want to borrow money, so they issue a bond. I wish I could issue a bond for 100 million or a million. So here's a bond, Charles Kelly. I'll pay you in 10 years and give you a little bit of interest on top while you've got it. It'd be great, wouldn't it, if we could all issue our own bonds? But that's what governments do and big companies do. I'm just joking now. You can't really do that yourself. But these bonds were mostly held by pension funds, and the Bank of England had to bail them out because they issued futures on these bonds and couldn't meet these margin calls. The Bank of England had to bail them out. And again, this week, they're also buying more bonds. They've stepped up their bond buying, basically money printing to buy government bonds. Let's face it, it's quantitative easing again. And they're doing that, more of that this week. And they said it will end on Friday. So it's more money printing to bail out the very financial institutions that, they're supposed to be regulating. Let's face it, the Bank of England are supposed to be looking after the money and the treasury and that sort of thing. They're supposed to be there looking after things, but they've allowed the economy to get into trouble. They've allowed inflation to go from their 2% target to 10%. And it's the same with the Fed. And they've printed all this money that's caused inflation, and now they're telling the government what to do. They're influencing government policy. They're going against the elected governments. And you've got the IMF as well. It's the IMF telling the British government how to run their economy. These are central bankers. Last time I looked, they were not elected to run countries. They're supposed to be doing what we tell them to do. And it's a bit like the tail is wagging the dog with these central banks. So look, what can you do about this? What can you do about central banks, the Fed, the EU, ECB and the Bank of England? What can you do about government policy? What can you do about all this financial crisis? The answer is not a lot, nothing really. We can't change that. But let me ask you another question. What can you do to change your economy, your economy? What can you do to change your own policy on running your economy? What can you do about how you manage your money and how you earn more money, how you generate more income? And the answer is everything. You can do so much yourself to change your situation that you can't change the bigger, wider economy out there, but you can change your own economy. So I've launched a new brand, which is called Financial Education for Financial Freedom. I want you to click on that link to subscribe to that. And what I'll be doing is sending you offers and special offers and course details, not just from me, but from other leading people that I've selected. And I've basically said these will be good for my clients. And I've vetted them and gone through their process and said, look, I think this will be useful to my audience, to my clients. And I'll be putting those in front of you. If you subscribe, and you'll then get my email updates on what you can do to thrive and survive, not only survive, but thrive in this coming downturn. Because a lot of people are going to be in trouble. And I do offer courses on how to manage your money, but I realize people also need to make more money, and that's why I've started this new brand, Financial Education for Financial Freedom, because I think we can all get there. And my 25 years as a financial advisor made me realize that whether you're in good times or bad times, a lot of people still struggle. A lot of people still mismanage their money. A lot of people go bankrupt as well, even though they're earning lots of money, because they don't know how to manage their money. So this is now, on top of this, those people are going to be in a worse position because of the financial crisis. So I'll leave it there, guys. Do subscribe to the link there down below, and I will see you again this weekend for the property forecast. Well, I'll be showing you why I think buy-to-let mortgages and buy-to-let purchases are going to become unsustainable with these high interest rates. Thanks a lot for listening. Bye for now. This is Charles Kelly. Bye for now.